Hey everybody, welcome to another live. Today we're doing something different. The live is on Saturday at 8:30 p.m. Eastern Time. I'm going to check and see how you guys can hear me. And hopefully everything is good enough to hear. And hopefully, pray we don't have any of those issues when it comes to the buffering last week. I think it was because of the weather, but I won't be on tomorrow, Sunday, so I figured why not talk today. So hopefully you guys are having a wonderful Saturday. I'm going to turn this music off. Hope you guys are having a wonderful Saturday. Like David said, hit the like button. Yes, please hit the like button. If you're new to the channel, don't forget to subscribe to the channel as well. If you like what you're hearing over here and the conversations that we have in regards to the live chats, and also, any comments that are left after the chat discussions. And thank you, David, for stopping by. Hey, Leslie, how you doing? Happy Saturday to you as well. And my dad is in the chat. He said hello to everybody. Hi, Clark. Happy Saturday. Tune in from Las Cruz, New Mexico. Wow. Okay. Well, thanks for coming over here. I usually see you over on David's chat, so I appreciate you being here tonight. Again, if there's any buffering lag, and let me know. Please hit the like button. It helps to push us through the algorithm, but it also allows you to get similar content if you love real estate content. And if the video is over and you're watching it on the replay, sometimes you might see a shooting star below. That's called a hype button. It allows us to hype up the video to do something similar. What the like button does, it just kind of magnifies it and pushes it a little further through the algorithm. Let me just check one more time, make sure my sound is good. All right, so let's get into some conversation. Hey, what's going on, Donna? Let's get into some conversation. We're going to talk about heirs fighting for parents' property, down payment assistance program. So I'm only going to touch on a couple programs and give you a little bit of information. Talk about loan applications being down a little bit, and then also we'll talk about how you might take deed in your state and what that could possibly mean. So all this conversation, I'm always going to preference it according to the person that you should get a full scope um, or a fuller dive into. So when it comes to certain things, we'll just preference it with, say, hey, talk to a lender for full context, talk to a probate attorney for full context, a real estate attorney, vice versa. But this is just, information that I know from experience. However, it's always great to talk to someone who is a professional fully in it outside of me just being a real estate agent. All right, so as you guys know, we usually like to check out where the rates are at as far as mortgage rates, according to Mortgage News Daily. And as I stated last week, I thought that we'd probably be going up, but it looks like we're softening a little bit with the rates. We were at 6.85, the highs about a week ago, and then we went down to 6.82, and now we went down a little bit more to 6.74 for a 30-year conventional, 15-year fixed 6.25, a 30-year jumbo 6.85, an ARM 6.29, a 30-year FHA 6.28, and that 30-year VA at 6.3. So again, these are national mortgage rate averages. This does not mean that this is where your rates could be at. It could be higher, it could be lower, or you could possibly fall into this category. It all depends on you, your personal debt to income ratio, and all those other overlays that you'll have a conversation with your lender when trying to get a loan to purchase a home, if that is what you're currently doing. Remember to always, even though some lenders will put you in certain pockets when you go to apply for a mortgage, remember to always try to see what makes sense for you financially. Is it to go conventional, FHA, explore that. If you're a veteran, explore that as well. And then also, depending on if you're in a rural area, you could possibly do USDA, and you can talk to a lender about that as well. Their USDA has direct and guaranteed loans, so you can definitely talk to your lender about those. USDA is typically zero down, along with VA is zero down. However, when it comes to USDA, there are, I believe, I don't know, it might change now, but at one point there were a certain credit limit when it criteria when it came to USDA. But again, talk to your lender because those things might have changed. All right. Okay. So let me know how you feel. Hey, what's going on, Croy? Clark, how are you? You have lives on Saturday. I'm feeling good. Can't complain. No, I typically don't do lives on Saturday. I'm doing it today because I will not be live tomorrow. So appreciate everybody stopping by today and taking the time out of your evening, if it's evening where you're at, because some people might be still the daytime. All right. So let's hop off of the rates again. If you are currently looking to purchase a home and you do have a pre-approval, if you were quoted a certain rate when you first jumped in the game, say if you jumped in the game last, you were quoted about 6.8 something, I would circle back around to your lender and see if with the rates softening a little bit, not that far down have they softened, but with them softening a little bit, I would check back in with your lender and say, hey, rates, I see that they came down a little bit. Could you quote me what a possible new rate would be for the loan? And of course, they can't lock them in until you go under contract. Okay. And sometimes lenders also provide floats, but you got to understand what your, how much things cost and what's going on with that. All right, now we're going to jump into real quick when it comes to heirs. The Great Wealth is called the Great. Sorry, I was reading an article. It's called according to Realtor.com. It says the Great Wealth Transfer Trap: Why lenders are pushing heirs out of 3% mortgage rates. Okay, this is by Realtor.com. It was came out August 4th, 2026. It says as more older Americans with low rate, excuse me, Jesus, I'm like gassy today. um, with low rate mortgages still attached to their home, some heirs report servicing delays and refinance pressures are putting their inheritance at risk. After their mother died, one heir said 2.7% mortgage attached to the house was what made it worth fighting to keep. This is the reason I keep fighting for the house, is to keep the payments where they are. The heir wrote in an uh, itemized complaint to the Consumer Financial Protection Bureau. I'm saying itemized. I don't think it's. But the mortgage company offered a new loan instead. The only option they offered me was a refinance offer. The complaint continued, according, adding that would have doubled the monthly payment and interest. The complaint, sorry. It's just one account in more than 200 such complaints involving obstacles to inherent mortgage assumption or successor recognition, identified by Realtor.com in a review of the CFBA complaint database. The complaints describe denied account access, blocked payments, and repeated documentation demands as balances and foreclosure deadlines inched closer. The findings echoed a 2024 CFBP review, which found a similar pattern of lengthy delays, repeated paperwork, and alleged pressure toward higher rate refinancing. Together, they captured a growing vulnerability of great wealth transfer. A family can inherit the house yet lose the financing that made it affordable. And so, again, you want to have more conversations with a real estate attorney around this in regards to when it comes to transferring that house over to you as a successor and an inheritor of said property. But from what I know, and also talk to a lender, which is the servicer that would be over that mortgage, once you provide said documentation, you should be able to actually um, take up that loan, and they shouldn't change the rates on you. But it seemed like, according to this article, that a lot of the complaints are everything's being delayed. And so with it being delayed, is kind of these lenders are kind of pressuring these heirs to basically say, well, to make it quicker, just refinance it. And they're saying, well, if I refinance, I'm losing that attractive interest rate, right? 2.7%, 3% rate. And it doesn't make sense no more to then hold on to the house if it's not affordable for the heir to take on. Let's just say if your parents bought a house, right, and they had a 2.7% interest rate or mortgage rate. Let's say they paid, it was a 30-year fix, they're down to 15 years left on that loan, that loan per se, and they have a nice attractive mortgage with 15 years left, and you're currently living somewhere as far as renting, and it makes more sense to then inherit your parents' house and move into your parents' house and take on a lesser possible mortgage outside of all the other fees that attach, right? You still have your property taxes, your insurance, if you're in an HOA, your home maintenance, but however, it might still be more feasible, and you actually have ownership and possibly be able to build some equity instead of just continuously renting when you have a house sitting here empty. And if you don't want to use it as an investment property, you rather just take it on yourself and move in, they're saying it doesn't make sense for me to take that particular property and then also turn around and have a higher mortgage because they want me to refinance said property. Corey said a road trip. Okay, I'm coming to. Yes, you could come along to a road trip. David said this is a great topic. Yes, this is a really great topic, and it's going to make me touch on how to take deeds. And like I'm gonna touch on Georgia, in which people take deeds in Georgia. And then hopefully you guys, will look into how you take deed in your state and make and get more of a fuller understanding. And of course, talk to a real estate attorney to get more of an understanding. But it made me want to look in more into like kind of break some things down. Leslie said, "Yes, great topic. Also, talk to a tax expert." Exactly, I love that too. Yes, a tax expert too as well to determine liability if you sell versus keep. Exactly. Definitely talk to a tax expert as well, because there are some taxes things that hit, and also depend on what state you live in too. If you guys don't know, some states have inheritance taxes too. So if somebody passes away, and if you're typically if you're married to said person that passed away, you don't have to worry about any type of inheritance tax, depending on what state you're in. There's 5 states that have inheritance tax. I know Pennsylvania and New Jersey are 2 of the 5 states. I forget the other. I think Maryland's the other one, and there's 2 more states. And if you're like a child or something, there's a percentage in which you have to pay when you inherited property. So there's a lot of different things to kind of decipher through, like you said, Leslie and David. But definitely, check into all those different things. It says an estimate 124 trillion will transfer intergenerationally through 2048, mainly from the silent generation and baby boomers, according to a report by the Cerulli Associates. I think I'm saying that right. Much of that wealth is tied up in housing. Boomers alone hold as much as 19 trillion in real estate wealth today, but more than ever, debt is attached to that equity. The share of homeowners aged 65 to 79 carrying mortgage debt rose from 24% in 1989 to 41% in 2022, according to Harvard University's Joint Center for Housing Studies. Nearly one-third of homeowners 80 and older also had a mortgage. And while it may seem like a liability in today's interest rate environment, a low interest loan is its own asset. And what I've noticed about a lot of the baby boomers or older people that might be still carrying a mortgage, a lot of them might have bought, let's say, 20 years ago or maybe 15 years ago, and they might have had a higher mortgage rate. And this is from when I look on the back end and Georgia's data. It's different, of course, according to where you're at, your city, your state. But I noticed that once certain times hit, right, when the great financial situation hit in 08, 09, and mortgage rates started to decline around like 2012, 2013 ish, 2014. A lot of people went in, they refinanced. Even when the pandemic happened, like my mom, she had went and also refinanced. She had a 30-year. She was paying down. I think we talked about this before. She was paying everything down. When she refinanced, she got a lower rate on her mortgage, and that rate was still equivalent to what she had prior, and she went to a 15-year mortgage, and she was still paying the same mortgage. So a lot of baby boomers or people that are a little elderly that have homes and they still have mortgages, they went in and they refinanced to be at a more comfortable monthly payment. So so I see that as well. Among active borrowers, 61% of baby boomers, 55% of the silent generation had rates of 4% or less in January 2024, according to Freddie Mac. So that's kind of the chart breaking everything down. Consider a home carrying a $250,000 mortgage at 3% with 20 years remaining. The existing principal and interest payment would be about $13.86 a month. Replacing that mortgage with a 6.66 loan while holding that balance and remaining the balance and remaining repayment period Jesus, sorry. All right, contest. Oh, sorry, would raise. I'm sorry, y'all. Something threw me off with this text. Okay, sorry. Payment to 1,888 says that's an additional $502 a month or more than 6,000 a year. So that's a big difference for people. Inheriting the house does not mean inheriting the loan. Those savings make a low rate mortgage part of the inheritance, and federal law is meant to protect the borrower's debt from automatically wiping out the advantage. The Garn-St. Germain Act generally prevents lenders from invoking a due on sale clause solely because of certain protected transfers, including a transfer to a relative resulting from a borrower's death. So if you guys don't know, a due on sales clause is what it does is it calls the loan. Oh Lord, sorry, somebody's calling me again. I just said I was on. People keep calling me. Every time I get on live, I told everybody I was jumping on live and they call me. That's why I keep keep getting thrown off by me reading. Also, so a due on sales clause, if you guys don't know, typically, this is something that is in the loan documents, and basically it says it's due on sale. The remainder payment of said loan is due if anything is transferred or things are done incorrectly. So let's say you go and you get an FHA loan or a VA loan, and you said that you're going to live in the property for a year, but yet you turn around and you turn it into a investment property, an Airbnb or whatever, and the lender finds out, you can typically they could typically do a due on sales clause because you're not utilizing said loan accordingly to the agreement in which you signed when you signed those documents. So that means that all that loan could be due, um, can be pushed to be due on sale per se. As far as like the 30-year fixed is gone and they're like calling the loan due now. And then there's other ways in which due on sales clause also. If like say if you're doing what's the other way? If you have somebody that does a subject to, I don't know if you guys know, a lot of people nowadays are doing like these subject to type of things where they're people are going to them and saying, hey, I'll take I'll cover your mortgage, you can move out, I'll take it up, and then you can um you know live your life or move away. And um and if they and if the lender also finds out about that, that loan could be due on sale as well. So I don't know if I'm making sense of what I'm saying, but let me know. In those cases, the lender cannot demand immediate repayment of the entire balance simply because the property changed hands. So they're saying in this case, because of the parent of said heir died, the loan cannot be due on sale, because the transfer of said property would then go to the heirs according to whatever probate you go through, whatever trust guidelines you go through, or whatever. But protecting the mortgage from immediate repayment is hardly the same as automatically making the heir the borrower on the loan. When someone inherits a mortgage home, they generally inherit ownership of the property itself, subject to existing mortgage. An estate planning and elderly sorry, an estate planning and elderly law attorney and partner at Fox Rothschild tells Realtor.com. The heir is not personally liable for the mortgage debt unless they formally assume the loan, but the lender can foreclose if payments are not made. So basically saying if the person, well, I'm interpreting this, I could be wrong, but I'm interpreting that if the person passes away and you don't keep paying said loan, because what typically happens, what I see is that a person will pass away, there's still a mortgage on the house. People living in said house, they'll still continue to pay the loan because unless you tell the lender that the person passed away, they don't know automatically, right? So as you're going through the probate process, as long as you keep paying said mortgage, they won't foreclose on it. They can't, foreclose on it per se because everything's still getting paid. However, once you assume said loan, everything goes into your name or whatever. You become the person to take on said payments, and you keep paying it. If you stop paying it, that's when it can cause some type of confusion. If the person passed away, you stop paying it, and then let's say 3 months you stop paying it. Now the loan is late, and you go to the lender and say, "Hey, I want to pay again." The lender's like, "Well, you're not the person on said loan, so you can't make a payment." Now this can possibly force you into foreclosure because you can no longer pay said loan because you are not that owner of the loan, and you're going through the probate, and you can't then pay the loan until they see the documentation. So most people will just continuously pay it. David said, I think we have one, two, not 100% sure. uh, you said one, two, as far as what? I don't know which one. I don't know, I was talking, so I don't know what you meant by that. Alex, hey, what's going on, Alex, with transfer of deed, the property tax assessors will be notified and taxes will reset, eliminating scarlet lock-in. Lower tax rate not transferable. Yes, correct. The tax rate will not be transferable. I think I froze again. Here we go with this freezing. Let me look for mine. I was hoping we didn't freeze. I'm sorry, you guys. I was talking and people was calling me, and I'm freezing now. So let's see, just to make sure. I was hoping we didn't freeze. Yeah, it's kind of being laggy again today. So I'm gonna try to find a different software to have conversations on. This StreamYard is not the best no more. All right. And so this kind of goes more and more into that conversation around that, the paperwork delays that they were kind of getting into. And so what I want to do is I want to touch on a little bit about this particular, where is it right here? this act that they said. I think it's the Garn, right here, it's Garn St. German Act. I pulled that up because I wanted to, give us some understanding about this act. So let me share with you guys real quick. Let me know how you're feeling. But yes, Alex is correct. Leslie is correct. Leslie said, of course, look, make sure you understand your tax stuff. So talk with a tax person. As Alex says, once that transfer is done with the deed, you definitely will not get those taxes will, change as well. Um, if someone passed away as a baby boomer and they're 65, 70 years old, if they're in like a senior exemption or a school exemption or those type of exemptions, and you come in and you're 30 years old, you won't get that same exemption. So your mortgage will change as well in regards to that. House, like the principal interest and the rate won't change when it comes to the loan portion of it, but the taxes will change. They might change the insurance as well. So you definitely want to understand all that. So it says the Saint German Act aimed to ease the pressure of banks, thrifts, and their insurance funds. The act expanded previous deregulation of deposit rates by creating a new money market deposit account (MMDA) for households that proved to be very popular. It also created a Super Now Act for businesses and government agencies. It removed some depression era constraints on thrift asset holdings to facilitate higher earnings. Thrifts were newly added to make non-residential and variable rate mortgages and change their charges more readily. It said Title II of the Act preempted state laws that all due on sale provisions in mortgage contracts that forced property sellers to repay their loans. In the absence of due on sale provisions, sellers could pass their low rate mortgages to buyers, thus preventing the lender from earning a higher market rate on repaid funds. While these changes were intended to raise thrift earnings, they often backfired with inexperienced lenders made mistakes and weak thrifts used the new powers to gamble unsuccessfully for recovery, and it goes on and on. But basically, this act they're saying falls under when a person is inheriting the parent's property. When it comes to those mortgage revisions, they're saying that according to this act that was put in place, I believe by I think Ronald Reagan. Let me see, it says up here. Let me make sure I have the right president because I might be wrong. Yeah, Ronald Reagan. Um, and then even though I feel like the entirety of it more is probably for the, like they say, the banks and all those type of things, but it kind of puts some protections in place for the consumer on a different level as well. So that's a little bit more about that particular act. So let me see. I don't know if I'm freezing. It might be freezing. You have to qualify if you assume the loan. I can see how it might be a problem if their heir already has a loan in their apartment. I'm pretty sure you probably do have to qualify as well, Leslie. I'm not fully sure about that. I would definitely talk, of course, to a lender about it. But I'm pretty sure there probably are qualifications, probably credit wise, different things and that might be a problem as well, as you stated, that some people are having delays, and if they own other properties, the debt to income ratios, different things like that. So I'm pretty sure there's several hoops to jump through. That there's always things to jump through when it comes to qualifying for loan assets and different things like that. Let me see. Let me know if you guys, if I'm buffering or if I'm sounding, if my internet is going wonky, because let me see. Let me know if you guys are buffering from, because it looks like I'm a little gritty. So I don't know. I was hoping that we wouldn't be like this today, but we'll keep moving. All right. All right. So the next thing we're going to talk about real quick is the loan applications have gone down a little bit. However, this is according to homes.com. They're saying, not that big of, it's not too bad because it's less than the week before. It says home loan applications fall as mortgage rates hit highest level in over a year. And they're saying due to, of course, elevated mortgage rates, consumers remain leery of applying home loans as geopolitical tensions have led to precedently elevated interest rates. Mortgage applications dropped 2.9% from last week on a seasonally adjusted basis. The Mortgage Brokers Association reported Wednesday purchase applications fell 4% from a week earlier, while refinances slipped 2% from the previous week and off 9% from the same week a year earlier. The trade group said Last week, the Federal Reserve voted, if you guys don't know, they voted to keep the interest rate steady for a fifth consecutive meeting. But as far as the conflict in Iran continues, the average daily rate for a 30-year fixed rate mortgage rose to 6.81. So that was last week. Now, as I saw, the rates have softened, reaching the highest level in more than a year. Alrighty. And so this is basically saying right here, mortgage applications 2.9%. It's just showing you as far as when it came to July 17, 2026, they increased by 1.9%. Then the following week, when rates went up, they went down by negative 6.4%, and then they went down a little bit more. So this week was higher than this week. So they're saying at least we're seeing increase per se, not a more decrease. Applications volume for both refinance and purchase loans declined for the week and are now running behind last year's pace, indicating that higher mortgage rates have weakened overall demand. Fratantoni, I think Fratantoni. The share of refinance applications increased from 39.5% a week ago to 39.9%, while FHA mortgage applications rose 16.9% to 17.3%. The share of adjustable rate mortgage activity fell from 8.1% to 6.9%. So they're saying that FHA applications actually rose as far as people inquiring about FHAs. The adjustable mortgage rates ones that fell a little bit. The 2.9% decline in mortgage applications actually was an improvement from 6.4% slide record last week. Nationally, home sales in June rose 2.1%. So again, data is always lagging when it comes to sales. So it'll always be behind about a month or two from a year earlier. But more listings have led to limited price appreciation according to Homes.com National Housing Report. Market report June's median home sale price of 400,001 inched up 1.5% from a year earlier. The housing market is still struggling to overcome constraints, said Brad, the chief residential economist for Homes.com. The market may have bifurcated between two groups, sellers and buyers who are ready to move on their lives despite the rise in mortgage rates since early March, and other buyers and sellers who are more put off by the rising rates. The spring home buying season has generally been better than we expected following rising rates, but if this mortgage application report is corroborated by others, then it may signal that the good news we saw over the past few months is petering out, he added. So they're saying that the rates applications, of course, they fell, but they didn't fall as much as the week prior. However, with the rates going higher, people have decided to sit on the sidelines and just see what happens because the higher prices, higher rates make for higher monthly mortgage payments, and people don't feel that they can kind of weather that storm right now, which makes sense. You don't put yourself in financial burden that you don't have to. So I always tell people if you're buying or you're selling, especially as buyers, you don't want to put yourself in a financial burden. You want to take into consideration all of those other expenses you currently have outside of a mortgage that you will obtain if you decide to buy. You want to calculate that in because you don't want to have to change your lifestyle in order to be in a home. All right. Okay, so I know I don't. So let's talk about real quick in regards to the way you take deed in the state of Georgia. And I'm going to share. I was going to actually have rolled. I have a whiteboard, so we'll see what happens. I actually was going to talk about the down payments first, but down payment assistance first. But let's talk about the way you take deed since we just talked about the inheritance thing. All right. So the way you take deed in the state of Georgia. Okay, now I'm getting Texas again. The way you take deed in the state of Georgia, we have tenants in common or tenancy in common, however you guys. Again, so this particular topic, if you want to know more about it, and especially how you take deed in your state, talk to a real estate attorney. They should tell you how to take deed in your state, right? I'm just a realtor. However, this is basic information that we have, but to get more in-depth information on this topic, definitely talk to a real estate attorney. So in Georgia, we have tenants in common. Let me put the S. I put tenant in common. Let me put tenant. Sorry. tenants in common, the S here. All right, and then we have joint tenants with the right of survivorship. So joint. I wish I had a writing pad. I don't. So hopefully, I know you guys are probably hearing my clicking. So joint tenants. Let me see. I'm just gonna put it horrible. This is I'm gonna put right to survivorship. This is horrible, guys. I don't have a writing pad. Joint tenants right of survivorship. All right. So you might hear a lot of clicking, so I apologize. In advance. All right. And this is just we'll talk about this because the conversation we had earlier. All right. So in regards to tenants in common, this in the state of Georgia is already that's kind of like the fault when it comes to taking title slash deed in the state of Georgia, right? And so with tenants in common is basically unequal shares of so both of the owners can hold different percentage shares. So let's just say you have two. Let's say I'm gonna put owner one. Everybody's technical. Owner one, owner two, and let's put over here owner one. So ready, right down. Owner one, owner two. All right, so with owner one, let's just say we'll make it equal. We'll do 50% because it's better this way. 50%, 50%. All right. So basically, when you do tenants in common, you have two owners. Let's just say, even if you're married, say you're married, but you took D with tenants in common. Owner one, owner two, 50%. When this owner passes away. So this owner passes away. So put passed away. Passed away. Sorry, my scribble passed away. This is horrible. Pass. I'm gonna put pass away. Okay. This is horrible. This percentage right here that this owner has now, if you have to go through the legal probating situation, this percentage will then pass to their heirs. So even if the couple is married, if it's mom and dad's percentage 50% goes to his heirs. It doesn't go to mom. It doesn't transfer to mom. So mom is still alive, but now mom owns 50% of the property and your heirs own whatever percent. So let's just say there are two children. Now when you go through the legal stuff, it'll be like 25%, 25% that they could possibly split this 50% up to, right? But all this will be determined once you go through the probating to your attorneys and see how you would split dad's shit a percent up. But it won't go to mom, all right? So this is in the state of Georgia again, you guys. Every state takes D in different ways. So, all right, so now let's talk about the joint tenants in common. So with joint tenants in common with right to survivorship, is basically it's equal share. So owners generally they'll hold equal and undivided interest. So basically, when one owner dies, their share immediately goes to the other surviving owner. So you can get probate if you're on said deed. So let's just say we could say 50%, 50% here. Dad passes away. Again, I don't know why I keep making it pass away. But typically, the men pass away before the women. So we make dad pass away again. Dad passed away. Now, dad's 50% goes to mom. This is mom. So now she has 100% of said ownership of the property. I guess I should put a house or something. Of the property. So the heirs now have to wait for said mom to pass away to then inherit the property. So does that make sense, guys? This is horrible. I don't know if it makes sense. I know I'm on here. And then you can get a full understanding through a real estate attorney. When you go to a closing, right, talk to the closing attorney and ask them, how are we taking ownership and said deed? Because you want to make it better for your estate to pass effectively and possibly be able to skip probate if um, if there's two owners in the house, and if depending on how you take ownership of the deed. Again, will you fully pass, would children pass probate? No, unless it goes to trust or you put that person on a deed or different things like that. And you can have that conversation again with the attorney. They'll probably also might put you on to a probate attorney, but closing attorney, when you get to the closing table and having conversations, you typically take your deed and you want to make sure you're taking a deed that makes sense to you guys when it comes to going forward ownership. So let me know if that makes sense. So this would be heirs down here with the inherit mom stuff. This is in the state of Georgia. Every state takes deed, different title, deed, however you're going to describe it, takes it differently. So let me know if that makes sense. All right, so now let's get off of this. If you have any questions, let me know. Again, it's always great to get more information from your local attorney when it comes to stuff like that. Hopefully that makes sense. So let's get rid of this and let's go into, I know Miss H, she's not here tonight. She probably think because typically we come on Mondays. But I know she wanted us to talk a little bit about down payment assistance programs. So we're going to touch on that now too. So let's touch on that. And if you guys, again, if you guys have any questions in regard to the way you take deed, I would say the best thing to do is Google. Google's always your friend, especially nowadays. Google what type of, when it comes to deeds in your state, how are deeds typically taken in your state as far as ownership, title, basically taken in your state as far as ownership, because the deed is the physical paper of said title. The title is the ownership, transfer the ownership. The deed is the physical piece of paper that is recorded. Leslie said, also check the deed once it is recorded. Mistakes happen and you want to ensure the deed is recorded with correct ownership. Correct. Thank you, Leslie. Yes, I definitely agree with Leslie said. Make sure you definitely want to check the deed after it's recorded, because you can always go back and you can talk to go back and make those changes, but you want to make sure everything is recorded correctly, like Leslie said, because again, when said owner passed away, whether it be either side, mom or dad, or however you take it, maybe different girls take these together, best friends, or however you decide to take it. You just want to make sure things are transferred according to how you guys took ownership. Thank you, Leslie. All right, so now let's talk about down payment assistance programs. I'm gonna exit off this because I was trying to figure out how to highlight some stuff and I didn't know how to do it, so I opened it up. Um, yeah, let's talk about down payment. I also had on here a comprehensive plan. So we can talk about that real quick as I'm writing this out. So if you guys don't know what a comprehensive plan is, typically every county does their own comprehensive plan. So it basically tells you what the county or the city payment has planned for the next 20, possibly 50 years, as for development and for like infrastructure, different things in your county and your city. So definitely, depending on where you're moving to, you might want to go to your local county website or go to your local city website, type in comprehensive plan, and see what that what it's looked like as for developments and things happening 20 years from now, 50 years from now. This is the city, they get together and they write those plans out. So it's always great to know that you can see what's coming, what might possibly come. You can possibly see, let's say if you're buying a house in a certain area, you might already say maybe come 10 years from now, they're planning on expanding the highway or the road. That means they might claim eminent domain on property. So that means some of your property lines might be taken away, right? So you want to kind of know some of that information. So it's up to you. as a buyer to check it out, for yourself. Make sure you go read it. It's very comprehensive. It's very detailed. Like I'll show you a quick comprehensive plan of the county I live in, Cobb County in Georgia. This plan is about 87 pages and it's for 2040. But we're gonna talk about down payment assistance and I'll show you that plan because we'll just skim through the plan because it's a long plan. Okay, so down payment assistance programs. We're gonna touch the surface, and then of course, like I always tell people, talk to your local lender about some of these programs. So see what happens. Typically, sometimes people will use like an online lender, right? That's not privy to some of the area in which they're trying to finance in or purchase a home in. So sometimes these online lenders, say Rocket Mortgage, different things like that, they might not know all the specific down payment assistance programs. So some counties have their own programs, cities have their own programs. You have statewide programs that the online lenders might be privy to. You have different down payment assistance programs, right? There are terms, there are guidelines and things in order to qualify for some of these programs. So when it comes to down payment assistance programs, you have forgivable programs, and then you have non-forgivable programs. First, non-forgivable. Oh shoot. And of course, you can ask, the realtor, they know of any down payment assistance programs as well. And I always tell people how to understand down payment assistance programs because they might not benefit you. Some people can get full benefit from it. Some people it doesn't make sense depending on how you're deciding to like what's your goals and your plans. All right, so forgivable basically means, let's just say, so down payment assistance program typically they come in the form of a loan, right? Even if they might say it's a grant X, Y, and Z. It's still quote unquote, it might be quote unquote a loan. So it might be second signed against the first. It might be zero interest on it, but at the end of the day, it's a second sign. And so forgivable, you typically they might say, oh, the loan is forgivable after 5 to 10 years of living in the property, right? So within that 5 to 10 years, you can't sell it, um you can't use that as an investment property, you can't do any of those things because it might trigger said payment assistance. And whatever, let's say you went through, say it's a 5 year forgivable, went through 4 years, and then that fifth year you decide that you turn it into an investment or something, or you try to sell it. Put sell it. Let's just put sell because that might be better. And you try to sell it. Oh shoot, sorry. You try to sell it the fifth year, so it's sell fifth year. This is so sloppy, y'all. I don't typically write like this, but I'm on a whiteboard. You try to sell it the fifth year, and when you try to sell it the fifth year, you might be left with a certain percentage to pay back. So within 5 years, I think they usually do like 20%, 20%, 20% every year. So you might be left the fifth year to pay off 20%. So again, you want to get, you'll get more information depending on what down payment assistance program you use. Make sure you understand the program. What happened? Oh, Jesus crap. Okay. I'm like, what is going on? All right, so non-forgivable basically means that the down payment is not forgiven. So when you go, it's not forgiven. So when you go to sell the property, invest, sell property, you turn into investment. Sometimes some of them will say we refinance it. You'll have to pay back 100% of what you borrowed. So I put 100% of what you borrow. All right, 100% of borrowed funds. So let's say you borrow $10,000 in order to use for your down payment to get into your house. You borrowed 10K, and now you're trying to sell. Let's say you're trying to sell 15 years later. You have to then pay back this 10K when you sell. So let's say your house. Let's say you bought your house. Let's just say, well, we got wherever we bought. Let's just say you sell your house now for $250,000. After all the fees, we just gonna say we're just gonna put minus fees, and we're just gonna make up a hypothetical number. Typically, fees is about what 6 to 7%. Sorry, y'all. Somebody else is emailing me now too. This is actually one of the lenders that I'm working with. One of my clients is emailing updates. And so let's just say deduct 7% fees because, and I said those fees because you have like realtor fees, title fees, all that stuff or whatever, right? And then also if you still have a mortgage on the house, you're gonna have your mortgage, your lien is they'll call it probably like your payoff, which is your lien against your house if you still have that. So let's just say your mortgage is you have that for 100,000. This is just being hypothetical, you guys. So now you're at, we're gonna take this out real quick. We're gonna not put that in here. We're just gonna do this 250 minus 100,000. You're at 150. It's hitting me now. And then we're gonna take 7% in those fees. So I'm gonna just do it real quick on my calculator. And my math is gonna be a little off. I'm doing real quick rough math, you guys. So don't beat me up. Say one. We're gonna do. So this is so off. This is, hold on. So you're gonna take 7% off of the 250. So that'd be like 17,500 in fees. Again, this is rough math. So we're doing 150 minus 17,500. So now you're down to 132,500. And then now you have this non-repayment, this non-forgivable down payment. So now you take that, deduct that by 10,000 as well. 0.05221. All right, and so there might be other fees that might pop up in here, like if you didn't pay your taxes in fully, so that might be prorated or some way. Maybe you didn't pay your insurance in fully, so other fees might accrue. So I'm doing rough math, but just be mindful when you're doing a down payment assistance program. You preferably, if you decide you want to take this route and you're trying to get money from said government or city or whatever fund, you want to kind of take maybe the forgivable route. You want to kind of go with the lower forgivable if possible. So also down payment assistance programs, I don't know if you guys know this, some of them might raise your interest rate, right? So that's just you do get a grant, and the grant is like, oh, it's forgivable once you close. There are some programs that they say once you close, it's automatically forgivable. But you want to also look into say, okay, would it be automatically forgivable at closing? Am I seeing a higher interest rate because of said grants? Because what people got to remember that nothing is free in America. And I always tell people nothing is free. You're getting hit somewhere when it comes to money. I'm glitching on my end. Let me know if I'm glitching on my I'm glitching now. So nothing is free. So the fees are being passed somewhere else. Money is being passed somewhere else. So sometimes what they do is on some of these programs, they'll have a higher interest rate because within that higher interest rate, basically is some of that fee is being pushed. And then if it doesn't have a higher interest rate, there is another type of. That's why you're holding on possibly the 5 to 10 year forgivable period, because there's other, like, typically with some of these down payment assistance programs, it's sometimes federal bonds attached to them as well. So you just gotta be mindful as far as the down payment assistance programs. We're just trying to do make it make sense to you. I'm not saying don't use them. I'm just saying make sure it makes sense to you. There are people that do not forgivable down payment assistance programs because most people do look at like this is my forever home, and it's great to look at stuff in that way. But I always tell people we have to be realistic. We don't know where we're going to be in the next couple of years or the next future or the future per se. Right? Life is ever changing. We don't have a crystal ball. So we want to kind of start to put our mindset in the sense of like, yes, I want this to be my forever home, but if something should happen, how am I in a place that the house is easily sellable? Am I in a situation where I don't have to pay a additional down payment back? Because I had a conversation with a lender with someone who actually used a non-forgivable loan in the state of Georgia, and I'm actually going to bring that program up in a minute, the down payment assistance program. And they unfortunately lost their job. in their area where they purchased 2022. I did not help them purchase, but the lender, I work with the lender, so she said, possibly assist with selling, and I asked me to do some rough math regards to what it would look like, but I also look at the comps in the area. And when I gave her back my comp analysis, I let her know that there had been softening in that particular place where she's at, and she bought higher. So with her losing her job, but then also having no like there's no equity now. She owes more than what the house is worth, and then also having a non-forgivable loan and 12,500 that have to be paid back on top of the sale. It makes sense. So basically, this particular person has to stay in their house, and I don't. And fortunately, they might foresee they might see foreclosure because they are struggling to obtain a job right now because it is hard right now. And it's no fault to her own, right? It's just the way the economy is going. It's just the way how life sometimes goes us these obstacles, these turns. And so you just want to be mindful when you're using down payment assistance programs. You want to have these conversations with the person that's providing down payment assistance, right? You can reach out to realtor locally in your city, in your state, in your county, however you guys want to put it, and you can ask them, do they know of any down payment assistance programs, and they can show them if they have any that make sense to you. You can look through them yourself, see, and then actually reach to said program and talk to them. Some of these programs do require that you take a home buyer education course as well, and we'll kind of just go through them right now so we can see with a couple programs. Hey, what's going on, Corey Clark? In Florida, it's 7 years on most down payment programs. In my opinion, after you jump through all the hoops, you're better off waiting until you have a larger down payment, as I am doing. Yeah, sometimes, like you said, it doesn't make sense for everybody, right? Some people need the down payment assistance because they can't actually afford to save. They can't afford to save because the way in which the world is kind of moving right, nowadays. Most people that are renting can no longer actually put enough money aside from the job in which they have to actually rent, pay a car note, make sure that they have food on the table, pay their utilities, and all these other things that add up, student loans or X, Y, and Z, and they're barely getting by, so they can't even put money in a savings account to save to afford a house. So because of that, some of these people then go over to down payment assistance programs. Am I the biggest fan of you doing a down payment assistance program without having money in a bank account saved? No, I'm not a fan of that at all. Some realtors will tell you, "Oh yes, you qualify." A lot of realtors, they will push down payment assistance programs. I don't push them heavily. I'm not saying that they don't exist, and you can definitely utilize them. I just say I still want you to have some type of money in your bank account because down payment assistance will pay for your down payment. However, you get in a house and let's say your water heater breaks, even if it's a new water heater or if it's a 5 year old water heater or whatever, or it happens like you have a new roof, but yeah, a storm occurs a month from now and a tree falls on your house. All these things happen. And now you want to be able to have some funds in a savings account somewhere since you didn't use because you were able to utilize those down payments from those city or state programs, but you still want to have these funds allocated for home maintenance for things that occur because stuff occurs, you guys. Life, things happen. Like you guys know, I'm having a problem with like I had a problem with my car and different things like that. I had a car that I paid fully off, and then coming in, I had no car note, and now I have a car note again. Right, my transmission went. It's just life. Life happens. So yes, that's good to know, Croy. Yeah, I don't know much about Florida's programs, but I'm going to touch a little bit about Georgia's program, and then we'll look into PA and Jersey a little bit as well, because those states I know a little bit about. But I'm going to touch. So this is a program in Georgia that a lot of people like to kind of look at. It's called Georgia Dream. Um, I did have a client utilize this program, and then I had another client recently utilize the program, but they use it different, right? So Georgia Dream at one time back in the day, they said that this program did allow for the loan, the down payment to be repayable. However, I mean to be forgivable. However, now it's no longer forgivable. It's a non-forgivable loan. According to them, they said back in the day it allowed for it to be forgivable. When I read the information back in the day, I didn't see that, but realtors said that's what happened. But I think it was forgivable. I think a lot of them might have took out of terms because I think it might have been forgivable. They might have felt like it was forgivable because during the housing crash that happened, they were allowing people to basically for it to kind of wipe off. So a lot of realtors thought at that time it was forgivable, but from the documents that I read, reading the whole, like fully and invested in actually reading this information, I didn't see it, but I could be wrong. All right, so Georgia Dream is a program in Georgia. They have different tiers. They have Peach Advantage, Peach Plus, Peach Select VA, um, and so these are different products within this Georgia Dream loan. And it says standard all eligible homeowners may qualify. It says 5% of the property's purchase price or a maximum 10,000, whichever is less in the lesser amount. So I see most people obtain about. So this is just all home buyers are eligible. Then it breaks it down to who can get a little bit more. So I really see people get about, if they take the program, 10,000. Protectors, educators, and nurses. Are you a public protector, educator, health provider, or you work these in industries, active military? You can get about 6% of the property's purchase price or a maximum of 12,500, whichever is the lesser amount. And they have choice one is a member of your family with a disability. You can get the similar thing as far as the protectors, educators, nurses, and VA people. All right, so it says eligible applicants for Georgia Dream. You have first-time home buyers or home buyers who have not owned a home in the past 3 years. So yeah, so some of these down payment assistance programs will also have it where you cannot have owned a home within the last 3 years. So typically, to be a first-time home buyer, you have to be 3 years from ownership. So that means, so some people might interpret it, oh, I own a home now, but 3 years later I want to buy another home in my first time home. Or no, you have to have sold that home, say sold the home in 2020, January 2020. You have to wait all the way to January 2023. I always tell people 3 years in a day to be, cautious until you can actually be considered a first time home buyer again. You have to have sold that property and wait that 3 year period to be a first time home buyer. So some of these down payment assistance programs require you to be a first-time home buyer. Not all of them, some of them do. So you just have to understand that more thoroughly when you look into it. Those who purchase a home in certain areas, so you can also be, able to use the program in certain areas. It says who also says have a household income up to a maximum. So again, some of these down payment assistance programs have requirements when it comes to income limits. So you have to make sure you read that as well to see if you qualify. Have a liquid asset of no more than 20,000 or 20% of the sale price immediately after closing, whichever is greater. So you cannot have no more than $20,000 of liquid assets. So, and liquid asset can mean anything when it comes to like any readily accessible, such as like the cash, like your checkings and savings accounts, any like investments, anything that can be kind of converted into cash. You cannot have no more than such. So let's say if you sell if the sale price is like $100,000 and if it's 20%, it'll be $20,000, right? Or if the sales price is $200,000, if it's 20%, then it'll be no more than $40,000. So you cannot have. And again, every program is different. So you have to just understand the program. All right. What else about this Georgia Dream? You got to meet, of course, mortgage loan criteria. And so yeah, so it gives you more and more, and then it breaks down the counties in which you can qualify in the household incomes, and also the thing about Georgia Dream, I'm trying to remember this. They count everybody over the age. I think it's over the age of 18 or 17. Anyone that's in the house that's bringing in any income is calculated into this as well. Um, so you got to be mindful of that as well. And then it doesn't break down like is it forgivable, not forgivable. So these are questions that you have asked. They do require with this particular payment program as well that you take a home education course, and so on that course they should be bringing down more information of how it works. This program also has something called tax recapture um, inside this as well. So basically that's um, it's the federal government, I believe. I'm trying to remember what it was. Like the federal government is issuing these mortgage rates, and because of that, they have this recapture tax that's tagged on. So you have 9 years. I would say it's 9 years after you purchase that the recapture tax disappears, and then you're just left with the down payment you have to pay if you sold the house in the future. But if you sold it beforehand with a recapture tax, and if your income, I think it's like if your income it's higher than what it was when you first purchased or like that. It has income requirements for capture tax. Also, when you sell as far as having equity, then you have to pay whatever that percentage for capture tax back, depending on the year on what you sell. If you sell before the 9 years, so again, these are very nuanced details that you want to kind of dig deeper into when you do down payment assistance programs. But that's a little bit about the Georgia Dream, and there's more information in regards to that. But I don't want to bug you guys with all that information, especially if you're not in Georgia. There's another program in Georgia as well called. Let me know if this makes sense, you guys, because I know, since I'm in real estate, I just kind of talk about it on a whim, and I have to sometimes slow down to make sure I'm explaining it and it doesn't get confusing because I don't want to confuse people. So, like, there's another program in Georgia as well in Metro Atlanta. It's called Atlanta Housing. They have down payment assistance program as well. It says the Atlanta Housing Down Payment Assistance (DPA) program provides down payment assistance to eligible first-time buyers up to $20,000, subject to meeting both the program and primary lenders' requirements. Safety, health, care, education, current military, veteran, and voucher participants are eligible for up to $25,000. So some of these down payment assistance programs too, they call them stackable, meaning that if you talk to the lender, some of these programs can be stacked using other down payment assistance programs. So if you do decide to use down payment assistance, you could. This one might be 20,000, another one might be 10,000, another one might be 30,000. You could walk away with down payments up to $50,000. It says Atlanta Housing DPA can be combined with other sources of DPA if approved by Atlanta Housing and the primary lender. So again, that's the whole thing of being stackable. The down payment assistance program that they provide can be stackable. Processing takes about approximately 30 days after the primary lender receives a complete credit file. So they do have to review your file. Most down payment assistance programs will review your file to make sure you qualify. Right, there are criteria in order to qualify. Purchases involving occupant, co-borrowers, or co-signers are not eligible. So these eligibility criteria are subject to change without advance notice. So they are able to change the criteria. So be mindful. You might go and say, "Oh, I was told this after I took the home buyer education course." They're like, "Oh, well, we decided that we're changing it to this," and then you might not qualify no more. So there's something else too. So you have that whole thing in your head where like, I'm getting this down payment assistance to help me buy because I need it because I can't, successfully save in this economy, and you want to utilize this because you want to purchase a home. You gotta be mindful that they can change the requirements at any time. It says first-time buyers who have not owned a home in the past 3 years, exclude any ownership interest in residential commercial property during this period. So again, even if you have any interest in said home, even if you didn't buy a home, if your name is on a deed of a home, if you have a partnership with investor group or something, even if it's an investment property, you still will not qualify for this particular down payment assistance program because you can't have any interest in it. The purchase price must be at most $375,000, so it cannot exceed $375,000. The liquid assets of the buyer cannot exceed $35,000. So similar to what Georgia Dream is, you can't have more than a certain amount of liquid assets. Buyer contribution or owner funds for the purchase must be at least $1,500. So when it comes to this, they're saying that you have to be at least $1,500 to the deal, according to what they told me when I talked to them before. So let's say you're buying a house for $200,000, and most people typically put 1% down for your earnest money. So once you put the $2,000 down, you already be $1,500 into the buyer's contribution or owner fund for the purchase. So you don't have to worry about the $1,500. The thing with them, I did add Atlanta Housing because what Georgia Dream does, which most people don't realize, is that if you put down more with your earnest money deposit outside of what they want you to have into the deal with the down payment, they will refund you that at the closing table. With Atlanta Housing, I believe the lender over there told me said they don't refund the difference. They're not going to give you like money at the closing table. So again, get more understanding of these down payment programs so you guys can use it to your best ability if you need it. Income must be at least 8% of the current HUD MSA area median income. So again, the area median income is saying that income must be at least 80% of that current. So let's just say your area median income $80,000. Must the income must be at least must be at the most 8%. Properties must be located within the city of Atlanta. The property must be the buyer's primary residence. Second homes are prohibited. So you cannot, can't be taking the FHA, VA loan, or conventional or whatever and turn it into a secondary. Even though a lot of people, trust me, a lot of people use these programs. People, they be saying one thing and then they go out, they be doing other things. That's why there's so much mortgage fraud going on. You guys will be surprised when I'm looking at the back end. I'm like, oh, this person is getting mortgage fraud. Applicants must meet the primary lender's credit requirements and secure approval for conventional FHA VA loan financing. Primary loan term can range from 15 to 30 years and must be fixed rate. And so you have to have proof of residency. So this is another one. So like I realize a lot of people that I typically work with are relocating to Georgia. So a lot of them don't qualify for this down payment because you have to have proof of residency for 6 months in the state of Georgia. So if you're in Georgia, if you're a Atlantean, if you were born and raised, or if you just moved from, let's say, you moved from Savannah up to Atlanta, then you can utilize this, right? If you're moving from, let's say, Colorado or something in Georgia, you haven't been there for 6 months, you can't even qualify for this particular down payment. It says eligible properties include single-family detached homes, townhouses, condominiums, undeveloped land is not qualified, so you cannot get undeveloped land to build a house on it. And complete an 8-hour homebuyer education class approved from HUD. So the 8-hour homebuyer education class, typically they'll allow you to take them online, 8 hours, and to get done, in order to qualify for down payment assistance. So that's a little bit about some down payment programs in Georgia. Let's touch real quick about some programs, real quick in Jersey. So if you're in New Jersey, and so again, you want to talk to the lender, you want to talk to the person who's over this down payment program. Sometimes when you utilize some of these down payments, like let's say you might work with a local credit union in your area, and they might say, hey, we have grants allocated to down payment assistance. However, you have to utilize that credit union to be your lender as far as when it comes to purchasing the house. So they have to be the one to facilitate the origination of that loan for your home purchase, and then you qualify for some of their grants and their down payment as well that go all just underneath of them. So like Georgia, we have Renaissance Bank, like they have different things. We have another one called Truist. Was it Truist? Citizens Trust as well. They have grants that they're always giving out money and down payment. You have to utilize them to close the loan. So that's another thing too. So typically I'll get some buyers that'll come to me and they'll already have another lender in place. And like I always tell people, you really want to shop your lenders around, just like you want to shop your realtors around. Okay, stuff is popping on my screen now. Sorry, you guys, I'm talking and this stuff is popping up. But just like you want to, shop realtors, you want to shop lenders. You definitely want to shop, home inspectors, shop anything when it comes to the housing thing, and then make sure whoever you're utilizing is the best interest of you and makes sense for you, especially when it comes to the lending part of your finances, because this is a mortgage that you'll take on for 30 years, and hopefully you can, pay it off quicker, maybe refinance if possible down to 15 years, things like that. But you definitely want to shop around. And like I said, sometimes some of these down payments or grants you can't get if you use different lenders if they don't provide these this funding, because they might only provide if you utilize them to originate the loan. So that's conversation you definitely should have with your lender. So like when you talk to a lender, you can ask them, of any down payment assistance program? Do you have any that's just particular to your company, to your bank branch or whatever, to the county that you work in, different things like that. And then sometimes if a bigger online lender does say, oh no, but you can ask your realtor. And so when you ask your realtor, the realtor will typically send you to statewide down payment programs, because when you kind of dig into some of it, you might get statewide, maybe some county ones, but when you get into other nuances of it, you might have to go to a different to a lender that accredit you that gives those specific down payments or grants, and just so you get some information. I keep saying but anyway, New Jersey, in regards to down payment, buying home New Jersey, you feel outreach when you're a first home buyer. After all, as of January 2025, the stadium home, so they're talking about how much the home is, blah blah blah. So let's say, so you have in New Jersey, you have the New Jersey First Time Home Buyer Programs. You have New Jersey HMFA, First Home Buyer Mortgage. Right here, you have this program. It's a competitive 30-year fixed rate FHA or VA USDA loan, which can be combined with agency's down payment assistance. So this one seems like a stackable. Repeat buyer shopping in target areas. So again, you have to be in certain areas to get this down payment. May be eligible provided they don't currently own another home. So you cannot own another home. So you have to be a first-time home buyer, or again, sold that within the last 3 years to turn around and utilize this loan. And then it says right here the requirements: buy a permanent resident in Jersey, have not owned a home in the last 3 years. You have to buy in the target area by the program, meet the credit score requirements, debt to income ratio requirements, Again, every down payment assistance program has these requirements: credit score requirements, debt to income ratio requirements. Um, so typically, they all have different terms, and conditions. And it says meet NJHNFA income and purchase price limit. So again, I don't know the ins and outs of these particular down payment programs. I don't know if this one is forgivable or not forgivable. This conversation you have back end when you look into the programs. Leslie said, when shopping, lenders check APR, not the loan. Also make sure there is no penalty for repayments. Yes, definitely. Thank you, Leslie. I love that Leslie's here because you found out with some information as well. And this is the reason why I do these lives. We have great chats and get more information from other people as well. So I appreciate you, Leslie. But yes, you definitely want to check the APR rate. This is a conversation I actually had with a recent buyer where they sent over that their loan, that they were getting a mortgage rate of, I think they were like 5.99 or something. The APR was like 6.9 or 7 or something. And I was like, I'm like, there's possibly, I feel like there must be some fees attached here because the APR is higher and it's not close to that mortgage rate. And then, of course, we're right. She went back, talked to the lender. Lender said, yeah, we're charging you a premium rate. But if you want the par rate without those fees attached, which I told her, ask them if it's the possible par rate with no fee attached. Of course, the rate was higher, but definitely the APR was higher. So the um, that was I don't know if that makes sense, but let me know if that makes sense, you guys. But thank you, Lily, for bringing it up. I appreciate you. And so I have another one. I'm not going to read through all these programs, but I'm just going to touch on a little bit because what I'll do is I'll try to link the articles below when I'm finished if you want to look at them a little bit more. So let's go into another one real quick. Let's go down to let's go to this is I want to go to one specific to like a city, right? So people can see that there are city programs as well. So city specific fire assistance programs. We have Newark. If you live in Newark, Live Newark Home Closing Costs Program. The program provides eligible borrowers up to 20,000. It's a no interest forgivable. Right here it said is it forgivable? Uh um Jesus DPA for down payment, so down payment assistance and closing costs. So it can only be used for down payment and closing costs. It says every year the borrower lives in the home, 20% of the loan is forgiven. So this was what I was talking about earlier, how it's like 20%, 20%, 20%. That typically most of these down payments they're silent second, no interest, so 0%. However, at the end of the day, they still you still have to pay to move within the time period before it is forgivable. Because until after 10 years, the balance is forgiven completely. So this one you have to be there for 10 years. The 10 years is the balance is forgiven completely. And then there's percentages that are taken off. The percentage changes depending on if you sell prior to the 10 years. All right. It says the requirements is buyer primary residence in the city of Newark. This one is specific to Newark. Qualify for a mortgage loan and provide a copy of signed contract of sale and meet HUD income limits. So again, it has limits. This is breaking down the pros and the cons. We should deal with that, but we'll do it real quick. The pros, it says open to multifamily homes that require repayment. It does require repayment if you stay longer than 10 years. It doesn't. So we got this is a little vague because technically it does if you sell before then. Can be used for down payment and closing costs. Great. Cons, must commit to buy two homes, qualify for assistance. All right. So these are city specific, state specific, county specific. So this one is Trenton as well. So if you're in New Jersey, so I will try to make sure I link this below when we finish. Hopefully this makes sense. Let's touch real quick a little bit on one in Pennsylvania. So if you're in Pennsylvania, so again, every state has down payment. Cities, counties, you can look into those as well. And again, local, probably a credit union, local banks, you can talk to them as well if they offer any down payment assistance programs, any county grants, city grants that come particularly from their bank. But again, But I've experienced that most of these grants or some of these down payments, depending on when you go to like more specific programs, like that one Invest Atlanta and all the things, they're confined to a certain area, a target area. So just make sure you know you're also purchasing in that area. So let's go through this real quick for Pennsylvania. Let's talk about this one right here. So it's Pennsylvania Down Payment Assistance Program. Access Down Payment Closing Cost Assistance says the Access Down Payment and Closing Cost Assistance Program offers 15,000 interest-free loans to eligible buyers or people living with disabilities. So this is if you have a disability, if you're eligible buyer, if you have a disability. So 15%. So again, interest-free will be 0% interest. All right, it doesn't go fully into the rest, but again, look into this one. The Keystone Advance Assistance Loan Program. This second mortgage offers no interest loan up to 6,000 or alternatively 4% of the house's purchase price, whichever is less. You repay it over 10 years using the loan toward your down payment or closing costs. Additionally, such Pennsylvania first-time home buyer programs can be combined with an HFA for a loan with the Pennsylvania Housing Finance Agency. So this one seems like it might be stackable as well. Um, it comes to you will repay it over 10 years. So I'm guessing, don't take my word, repay it over 10 years. I'm guessing it's forgivable, and then within 10 years, it's completely forgiven. But again, you want to look further into this yourself and talk to your local the person who's running the program or the local lender who is over this particular down payment program. But yep, so that's some information about different down payment assistance programs. Like I said, I'll link that below. Hopefully it made sense. The forgivable, non-forgivable. You want to get that nitty-gritty of that information because you don't want to get caught up in a situation where the down payment is forgivable, and then you realize you have to pay that when you go to sell your house. And if you're looking to try profits for equity after all those other fees tacked on, any liens left on the house, mortgage liens, if you have HOA lien, if you have any type of things that's owed on the house, say you took out a mortgage as well, you just want to be very mindful in regards to these programs. And yeah, so I'm gonna go real quick when it comes to the comprehensive plan. We'll be out here tonight. I appreciate everyone sticking around. I know it's a long live, but like I said, I'm not gonna be on here tomorrow. But I appreciate Leslie, Corey, Alex, my dad, David for coming by for a little bit as well. Um, Donna for stopping by as well. I appreciate everybody who tuned in and people who might just be watching but didn't chat. I appreciate you being here as well. And then anybody watching on the replay, if you have any questions, need any assistance, you can always reach out to me. I'll put my information. Oh shoot, somebody's spinning off. I'll put my information below real quick. So I'm just gonna scroll through this quick. So again, every city or county, however they do, depending on where you live at, they have their own comprehensive plan. And if you want to know what's going on in your county in the next coming years, 40 years from now, 50 years, 20 years, 30 years, you can see what they're planning on doing. So this county, this is the county I currently live in, 2040 comprehensive plan, 5-year update. So they updated it October 22nd, 2020. Jesus. So yeah, so I'm just gonna scroll through it real quick. So you can see it's a very lengthy document, but it states everything. Shows you also you can learn who's your board of commissioner. You can learn the planning commission, so you can see who's in charge of the different districts that you live in. If you don't know what district you live in, definitely want to find out. You can also find the district that you live in on your Jesus, it's not the, is it the plat? Not the plat. The the D when they lay out the Jesus, when they lay out the whole description of like lot 2, they kind of lay out your whole description of your land and everything. County, so you get this information, community development agency. So this is very great to go online onto your county, onto your city, for a comprehensive plan, so you can get access to these people who are overseeing these different divisions. If you ever have problems, questions, concerns, be able to see who you need to reach out to. It gives you a table of contents, introduce you like what they're trying to do, when they revise it. Again, since the comprehensive plan is designed to be dynamic and capable of being revised based on the changing needs and desires of the community, the limited scope 5-year update is mandated by the state in order to maintain qualified local government status. As the county continues to grow, changes are inevitable based on the state's minimum standards and procedures. Certain components of the comprehensive plan should be updated every 5 years. Top count 2040 comprehensive plan and 5-year update focuses on the following: determine if existing needs are still relevant and if there are any new needs that should be addressed, gathering feedback and potential changes related to future land use guidelines and policies, include a broadband element, provide a report of accomplishments, establish a new 5-year work program. So they go dive into all that, dive into the land. So yeah, like I said, I'm just gonna go through real quick. So what they're saying as far as the community profile in Cobb County right now, they give you a profile, and everybody's comprehensive plan can be different, laid out different. This is just how they laid them out, laid it out. Because even when I look at Fulton County, every county I'm laid it out different. Community profile says age. It says by 2050, age 35 to 44 will be the largest cohort. Age 65 will double. 65 plus will double. So right now, they said the age is around 25 plus. A population forecasted to go by 2040 to 2040. Well, there's 2050 here. Property level is 2010, it was 39%. 2019, 8.1%. So it says since 2010, percentage of population level below poverty has decreased. Population increased at a slower rate. So basically, population is increasing, but people might not be having, babies or things like that, or maybe some people, might be leaving and other people might be coming, but it's not really moving but so much. But from 2015, 2020, 32.8%, 2020, 2050, they projected to be 35.2%. So this is what they're saying by 2050, by what currently seeing as far as the increase in population. Diversity says Cobb County is more diverse in the past and projected to increase diversity. This is saying the population as far as from 2,000 to 607,000 up to they project by 2050 it'll be millions of people in Cobb County. Well educated, over 50% have college degrees. Cobb County demographic and data summary. Home values, so they take the values of homes from 2015 to 224,000 by and 2019 was 283. They hope that it continues to increase. The median income is right here as well, and then households. So it breaks down a little bit more. So if you're coming to Cobb County, you got a little bit more data. Yeah, so just go through it real quick because, like I said, it's a very lengthy document, and it touches on all these things: land use, transportation, housing, broadband, economic development, intergovernmental coordination, senior services, natural and historic resources, libraries, public safety, parks, police making. So you can get all this information in your comprehensive plan and what's going to happen in the coming years. So yeah, so that is that information. Hopefully tonight's live was very resourceful. Again, I appreciate Leslie for giving us some additional knowledge to back some of this information that was given tonight. Also, I appreciate Croy talking about payment assistance programs in Florida. It says some of 7 years. And Alex, when it comes to, again, if you are inheriting property and you are taking ownership, the taxes will typically change because it's a different owner taking place depending on like age and different situations. In Georgia, if you're not have taxes too when it comes to if you're an investor and a homeowner. If you're a homeowner, you can file an exemption with like the homestead. If you're an investor, you can't. So if you are inheriting one of your parents' properties in a particular county, but you're not actually going to live in it, and or if you already own your own house and it's becoming an investment property, your taxes will be allocated differently. So I appreciate Alex mentioning that as well. And David, he said 100%. I don't know what he meant by that. I appreciate him as well. And you guys have a wonderful Saturday, and I will see you next Sunday. All right, take care. Bye bye.